Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm getting, and holy crap, we're actually getting closer and closer to this pivot in the market. And we saw what happened last time the Federal Reserve pivoted and massive money printing happened. We're going to look at some of the historical data and how pivotal this time can be in terms of generating massive returns for your portfolio over the long term. All right.
More importantly,
So,
hats.
hats, yes, totally hats. So this is what you're looking at from a CME, sorry, Fed Watch tool right now. This is what they're expecting for rates in the September meeting. 76% chance of a 25 basis point cut and 24% chance now of a 50 basis point cut. All right, that's like the midpoint for or expectations for the next meeting. Yeah, people will tell you that like I've never done it before a presidential election in September, but it looks like the market basically right now is betting on a certainty of a rate cut. Just how large is the question? And Jerome Powell's comments, see our other video, also point to the fact that he's ready to start cutting. All right.
Yeah, these next 6 months are. This is how money's made. So we have some cool data coming up.
Yeah. Yeah, exactly.
Oh,
So go to the
I'm
next
controlling
slide.
this. I
The
forgot.
interpretation, basically, this is what I just highlighted here. So 25 or 50 basis point cut in this next meeting, and then a 75 to 100 basis point cut potentially by the end of the year is what the CME Fed Watch tool is looking for, which is kind of bananas pivot from where we were looking for only one rate cut this year
Right.
as of 3 months ago.
Insane. I forgot I was controlling the thing.
Yeah, it's all good. But I mean, all the markets are really performing super well for the most part. S&P 500 is up double the annual average return so far this year at 18%, 19% for triple Qs, and 10% for the Russell 2000. We're going to look at a little bit of there's a slide that was put out that was the difference between small cap and large cap as far as that goes.
hmm
10-year rates already started to kind of cool back off from its peak. It's still at a relatively elevated trade. This really matters if you're in a TLT position. We could do a separate video on that at some point in time. Yeah, I know that Dylan right there. But we've started to pull back a little bit from the highs. All right? We haven't broken into quite new territory yet, but made some moves. And as a result, 10-year Treasury change, the mortgage rates have also come down. We now have, I think it was the 6.3% for the 30-year
hmm
mortgage fixed as of Friday, this most recent weekend. That's the most up-to-date data we have. Remember, come down quite a bit from the peak there. All right. So this is a chart of the historical Fed funds rate. And if you watch those periods where they're kind of decreasing the rate, you see a lot of recession tied to that. That's the real question that
Mm.
you have to be looking at in terms of interpreting the next steps is whether or not we will see a recession as part of this Fed rate cutting cycle. All right?
Which I'm going to talk about. This is cool.
Yeah. So this is from the Plain Bagel. It's a big YouTube channel. He's actually a finance professional, and he looked at I think it was the most recent like 8 cycles of the Federal Reserve cutting rates, and gave you the 1 day, the 30-day, and the 365 return, and then annualized it out to see if it truly is like a pivotal moment in terms of having significantly higher returns. And then he also broke it down between large cap and small cap stocks. So when you're looking at large cap, the 1 day return, if you annualize that out, is massive. At this 35,000%, because that day that they actually cut, we got a significant bounce in the market.
Right.
But when you're looking at 30-day and 6365 day for large caps, more in line with typical stock market performance, so it doesn't really have like a dramatic effect there. Now with the Russell 2000, they generally underperformed a little bit. They had a big pop that first day, not quite as large as the large caps, and it was a little bit smaller in the next 30-day, 365-day, and for the full campaign throughout the entire time. The other thing that kind of highlighted here is look at that dispersion. All right, there's a pretty broad swath here from negative 34% on the low side to a high of
Mm.
18%. All right,
Yeah,
so there,
jeez.
yeah, it's a pretty wide swath of potential outcomes once this happens. And the biggest driver, what he said basically was that whether or not we go into recession. Because if we don't go into recession, the data shows that it's going to be a very good return. If we do go into recession, it may be in line with the market expectations or slightly underperform.
Right.
Was his video.
So essentially, so Finn is correct. It's on if we go in a recession. This is Schwab released this, and this is just looking at 14 rate cycles when at the time of the first cut. It looks like preliminary data. You just glance at this, like 2 out of 12 were negative, so we're probably going to be 2 to 14 were negative. We're probably going to be positive. That's
Yeah.
the whole thing going on multiple YouTube channels. Like, oh, this is going to be a great thing. It's not. And I'm going to show you why. This looks like a very confusing slide, and I'm sorry for that. This is just the same data, So as you can see, same dates. I just made it vertical. So you have the two negative ones, yada, yada. Then you have your negative ones here. All right. So what matters is when the recession was. And the reason why there were so many positive returns after the rate cut is because with the green, the recession was way after, meaning more than 12 months later. Or
Okay.
most of these, the recession was before the rate cut. So the market had already plummeted. So obviously the next year it's going to go higher. So I'm going to show you this one. This one makes no sense. But like 1954, the recession was well before they did the rate cut on the way out. So obviously the 12-month return going to be way after. These two blue ones, the recession had happened about a couple months before. And if you look at these graphs, it had done most of the plummeting already. So by the time the first rate cut happened, you have a great 12-month return. So it was positive. Yellow is no recession. And then, like I said, black it was well before. Most of these rate cuts happened the last month of the recession. There's only been 2 times where there was a recession directly after. And look at those returns. Not
All
good.
right. So that's basically the question we have to answer, right? Is, if we have no recession, or we know we're not in a recession as of yet, then
Yep.
the only opportunity that we'd have that would be significantly deleterious to portfolios is if we have a recession that starts immediately after this rate cut.
Yes, within 5 to 6 months. That's what the data shows. If you have a recession within 5 to 6 months of the first rate cut, so assuming that is September, not good. Your 12-month returns are shitty. That's literally only happened twice out of the 14 times. Now, if you change this data a little bit, if you get rid of all the black and the blue, then, I mean, you're literally in 1, 2, 3, 4, 5, 6 of the 14 data points off the bat. So, we're not in a recession. There is a kind of a weird thing because it was like 6 months ago, we had 2 declines in GDP, but the labor market was super, super low. Those do have to coincide. It was not a recession. It's kind of odd. One kind of cool thing here. You see how it says Schwab posted positive return November 1929 here?
Yeah.
Yeah. I don't understand that. So here's November 1929 is here. This is November. I don't understand how they got this data. I did every possible ETF at the time, or index, sorry, and they're all negative. I don't understand where they're getting that data from. I gave up.
Accounting for dividends, maybe part of it. Because
Maybe,
obviously
but
companies
it
back then
was,
had a much higher dividend yield
oh,
relative to their
maybe
stock
that's
price.
it. That could be it. But it was real negative. Like November's like down here. I don't know.
Yeah, yeah, I
I'm not
get that. I mean, yeah.
not going to ask any questions. This is the effects of inflation as well as rate cuts on TLT. Okay, so this is the full chart. This madness is COVID. All right. So this yellow line here, we hit rates at 0 or 0 to 0.25. So you can see the crazy range. We went from like 132 to 172, bounce around. This is the effect of inflation just in this year, 2.6% to 8.5%. Gross, right?
Yeah.
These all these red lines, so these are rate cuts. Sorry, rate hikes. Shut up.
Nice.
I always say this
Yeah.
backwards. Just this bracket, you go from 0 to essentially 4%. Like
Wow.
that's why you have this really, really steep decline. And then we kind of chop back and forth and it catches back up. So there is a little bit of a lag effect on TLT. So I would not, if you're in the TLT trade, I'm obviously doing it. I'm not expecting it to skyrocket in September. That's not,
Yeah.
just because there's a rate cut does not mean it just automatically reacts. It actually looks like it can take 2 or 3 months, even longer, to even catch up, unless there's a recession.
Well, I mean, that's always the question right now. Is what do we predict for economic impact coming next year? It's hard to imagine, hard to know.
So after looking at those 14 data points and plotting when the recession was and the returns, you can see why some of them were very positive because they had just lost 20%, right? I'm going to do
Yeah.
this next week, but I'm going to look at the individual unemployment rate per month during that time, and just see if any of them correlate with now. Because in the last 6 months, we've went from 3.6 to 4.3, which that's fairly drastic.
Mhm.
History will show as that happens that usually does not slow down right away. However, Jay Powell's on the case, so we will see.
Yeah, he's loading up the money printer as we speak, just in case it's
Oh
needed,
boy,
just in case.
I hope not. No more money. We printed too much. Okay,
Yeah.
guys.
Catch you next one.